What you're looking at here is the perfect chart to illustrate just how unaffordable housing has become. This is the US housing payment to income ratio, a ratio that tracks the percentage of the median US income needed in order to make a monthly payment on a house with a mortgage. As this percentage increases, it means that people are spending a higher proportion of their income on home payments, and therefore means that housing is less affordable for the average person. As we can see from this graph, the ratio has been surging in recent months and has now reached 38.9% as of the end of September, with the rising mortgage rate a significant factor behind this increase. What's even worse is that the average mortgage rate has now creeped up to be higher than 7% with the new interest rate hike, so this percentage of income could well be over 40% as of today. The last time the payment to income ratio was this high was in the 1980s, and the ratio now exceeds the peak of the housing bubble in 2006 and 2007, just before the whole market came crashing down in the global financial crisis. What's really interesting is the fact that the interest rate is actually far below where it was in the 1980s and 90s. However, the payment to income ratio is still higher than what it was in the 1990s, which suggests that income simply has not kept pace with house prices, and people are getting paid proportionally lower on average nowadays compared to back then. Something truly does have to give way here, and we know it's not likely to be wage increases or an interest rate decrease due to inflation still being very high. So as I touched on there, the number one factor most likely behind the surge in payment to income ratio and the overall decrease in housing affordability across the US is the interest rate. Now, this interest rate set by the Fed has continued to rise, causing mortgage rates to rise with it, meaning that people need to pay more for their mortgage payments and overall making housing less affordable by the month. The average 30-year mortgage rate in the US has now reached above 7%, meaning that a $450k mortgage on a $500k property will now cost $3,413 a month in mortgage payments. Now, if we compare this back to January of 2021, where interest rates were just 2.65%, for the same $450k mortgage on a $500k property, your monthly mortgage payment would only be $2,208. Now, that means that mortgages are 54.6% more costly today than where they were back in January of 2021, which means that many people simply cannot afford to buy a house right now, or they have to go for a much cheaper alternative. Now, with the inevitable reduction in demand for houses as a result of this unaffordability, house prices are likely to continue to fall in the future to the point where demand starts to pick up again. Now, the last time mortgage rates were this high was back in 2001, so mortgage rates today are far higher than anything we've seen in recent time, including the peak that we saw of the 2008 housing market crash that happened as a result of the global financial crisis. Homebuilder sentiment continues to rapidly deteriorate, with the National Association of Homebuilders Housing Market Index recording its 10th consecutive month of declines in October. Now, this index is based on a monthly survey of home builders on current sales, sales expectations over the next 6 months, and the traffic that they are seeing from prospective buyers. Now, this continued fall in the index now puts us almost as low as the spring 2020 pandemic capitulation, in which there was peak fear about the market and overall economy. It also puts us at a similar point to where sentiment was midway through the housing market collapse in 2007 and 2008, and approaching the peak of this fear where the market did reach its lowest. Rick Palacios Jr., Director of Research at Burns Real Estate Consulting, backs up what this index is showing and believes that homebuilder sentiment is at an all-time low. He spoke to some homebuilders across different parts of the US, and some of the quotes are quite concerning in regards to where the market is heading. A Boston builder said, "October was exceptionally weak, implying that this is the weakest month they have seen so far. The market is terrible, the market is falling off a cliff, and the market is weakening," are all further quotes coming from builders in other areas of the US. Now, there were other quotes that suggest home builders are preparing to vastly reduce their new home build starts in the coming year. We'll cut starts 60 to 70% in 2023, and also preparing for a very sluggish 2023 with increasing incentives and price erosion, driven mostly by the need to buy down interest rates, are just another couple of quotes with quite negative sentiment. Now, builders are also hinting that there is still a heavy need to provide incentives for buyers, or even just cut asking prices quite significantly in order to offload building inventory. Updated data from Redfin, which covers over 400 metropolitan areas in the US, certainly backs up the idea that the housing market is heading clearly in one direction, and that is down. So first of all, there continues to be a consistent decline in median home sale price, which is now at $359,250, which is down 8.5% in just 5 months since the all-time high that we saw in June earlier this year. Now, similarly, the median asking price of newly listed homes is down to $372,475, which is a 6.9% decline from the all-time high that we saw for this metric in May. Now, as you can see from the graphs, the average home prices are approaching the levels that we saw at the beginning of 2022, and this is the longest sustained period of price declines that we have seen for several years. On top of this, there are several other key metrics that indicate a continued decline in the housing market. Now, pending sales are down 33.9% year over year and are now at the same level that we saw during April 2020 when we experienced peak pandemic fear. Now, this is clearly being driven mainly by falling demand because while home sales are down, inventory levels are climbing. And according to this Redfin data, there is on average 3.3 months worth of supply available on the market right now at levels last seen in summer of 2020. Now, this is up considerably from the lows that we saw at the end of 2021 and the start of 2022 at around 1.8 months of supply. And if we look at similar data from Thread and Realtor.com, it paints the same picture that inventory levels are definitely rising at a fast rate across the whole of the US. So national inventory is now up to 754k, which is more than double where inventory was in February of 2022 at just 347k, and is the sharpest rise in inventory levels we have seen in recent years. The difficulty sellers are having selling their home due to the sheer lack of demand on the market is also being reflected in seller pricing behaviour when it comes to trying to attract a buyer. The number of home listings that had price drops continues to climb and is now at 7.9% of listings. Now, this is up significantly year over year, where only 3.6% of listings had a price drop. On top of this, the average home is also selling for lower than the listing price and has now reached 98.7% of the final list price. Now, this continues to fall from previous months and suggests that sellers are starting to accept offers that are lower than the asking price. This is a stark contrast to where the market was in the summer of this year, where homes were selling on average for 103% of the asking price, meaning that most buyers had to actually offer a price that was higher than the seller was asking for, due to how much demand there was for homes back then and how much competition there was for getting a home. The data suggests that seller desperation is starting to creep in some cases, and could be due to how unaffordable housing is right now, how expensive mortgage payments are, as well as the overall cost of living crisis across the US. With many people struggling financially right now, including many people losing their job in recent months, it's reasonable to assume that some of those sellers who have been forced to drop their asking price or accept a lower offer are distressed sellers who need to desperately sell off their home in a short space of time. So pending home sales for September came out on October the 28th, and sales fell for the fourth consecutive month, declining by a whopping 10.2% month over month. Now, this was a much greater decline than the approximately 4% it was expected to come in at, and this pending home sales index is a leading indicator of housing activity, measuring housing contract activity, and is based on signed real estate contracts. Now, because a home goes under contract a month or two before it is sold, this makes the index a leading indicator of where home sales are going to go over the next couple of months or so. So pending home sales are definitely declining, but so are actual home sales too, with existing home sales in September declining by 1.5% month over month. On top of this, data shows that cancellations are rising rapidly across the housing market, and using data reported from Homebuilder companies that are publicly traded, including net sales, gross sales, and cancellation rates, we can get an idea of what the current cancellation rate is across the housing market. Bill McBride from the CalculatedRisk Substack has put together some fantastic data to show estimated cancellation rates now compared to in 2021, and I'll link the full blog in the description below. So as you can see from this chart here, home builders are seeing cancellation rates as high as 35%, with the average being approximately in the mid 20% range. Now, this is far higher than these home builders were experiencing in 2021, where they were enjoying cancellation rates as low as single digits. So the data is certainly pointing towards the housing market declining over the next year or so. But in fact, Ray Dalio, who founded and managed $150 billion worth of capital in his hedge fund, believes that this pain could extend across the whole economy and that we could be about to face total economic collapse in a once-in-a-generation event. I made a full video on this topic, which I think you'll definitely enjoy watching, and it is on the screen right now for you to click. Apart from that, leave a like if you enjoyed the video, subscribe if you want to see more, and thanks a lot for watching.